But why don't we move on to Kevin's presentation now? Kevin is doing a presentation on the missing middle in Toronto, and very much looking forward to that one.
Okay, so just kind of a brief background, a little bit of history on myself. I started in development back in 2012 in Ottawa. Always focused on what's known as the missing middle. So for those of you that aren't kind of familiar with that term, potentially, it's kind of considered that area in between what you'd see as a single family or a semi-detached, and then that space from that kind of built form up to, say, a low-rise condo development. So in Toronto, and I'd say Ottawa as well, we've kind of lacked that housing for a significant amount of time. And that's kind of come to the forefront as a possible solution to the housing crisis that we're kind of seeing in those cities. So my story kind of starts in Ottawa. I started off with trying to find or working in that kind of investment space. I started in secondary dwelling units, which were at the time kind of new to Ottawa. Back then, they were just kind of starting into the new zoning allowances for it. Then got into multifamily conversions, so duplexes to four units and triplexes, then into new construction. And then in 2017, I kind of saw that Toronto was very much heading the same way as Ottawa into this housing crisis where there just wasn't enough rental properties or rental units available. So we expanded into Toronto, and again, I was kind of one of the first into that infill space. Worked with the zoning that in certain areas of Toronto, and definitely took a considerable amount of time to kind of get the city and then the city council on board in order to move those forward. And after that, we kind of ended up expanding further. So what I'm kind of presenting on here is kind of a unique opportunity for investors who may have thought that Toronto was not really an option, or a large city like Toronto wasn't really an option that would work or allow them to kind of get into, and that the numbers wouldn't work. And we hear so much about condos previously that condos kind of that speculative game that investors played in Toronto, and obviously are kind of running into some significant headwinds now. So I'm going to kind of offer you a different option, something that I think might work very well. So back a couple years ago, for those that don't know, Toronto kind of worked on changing their zoning to allow for four units in a specific built form. That was kind of working with the province, and they kind of started allowing that. And then the city took it a bit further and then started allowing additional units, which not sure whether they even realized it, but they allowed builders like myself to kind of come in under what's known as the CMHC MLI Select program. So, for those who aren't very familiar with the program, it was designed by the government to kind of entice builders to move into a rental space and create rental units. So kind of the standard process, a builder will come in, build a condo building. There obviously the return is once they get out of the project. So on a rental side, obviously, it's a longer play. They're staying in it long term. So the government came up with this program that kind of offers incentives to investors and then builders to work in this space by offering longer amortizations, lower interest rate, and then a higher leveraged amount. So the maximum that the program offers, you can get up to a 50-year amortization, go up to a 95% loan to value. And then currently the rate right now is sitting around 3.5. So back a couple years ago, after I started kind of working on the triplex, four-plexes that I was infill that I was doing in Toronto, we pivoted into this space. And so with my background, I've kind of developed a specific model that we use, and it's replicated each time that we do the build. So that cuts our costs down, speeds up our build time through the processes with the city. So, for example, when I was working on the original build forms, we were down to 2 months from initial submission to the city for permit acquisition. So, for those who are somewhat or know about Toronto, one of the major issues that we run into is red tape and the length of time that it takes for permitting. So, to receive a permit in 2 months is a pretty, I'd say pretty impressive anyway from this, for the city. Um,
Kevin,
yes.
I'm just going to cut you off for 1 sec. Sorry to interrupt. Are you flipping through your slides right now? Because we just see
Yeah, no, I'm just kind
okay.
of setting it up so that I can kind of move
Okay,
on to the
perfect.
next ones.
Just wanted to make sure.
Yeah, so this is just the background. So, kind of fast forwarding. So, we have this design that we came up with that we can replicate, we can standardize. And so, we were approached by one of the lenders that we worked with who said, how can we come into this and provide financing for your builds? How can we partner together and create something that an investor would be interested in doing with us? And so that's where we kind of started this process. We started scanning the various options that you have in Toronto to invest in outside of Toronto, such as out west. And we kind of came up with this model. So on the financing that we could pair with our build. So the benefits that you're going to see that we actually get within this program, whoops, here, is you're going to end up with a loan to cost that's significantly reduced on the equity component. So this in regards to our build side. So our lender has actually agreed to go up to 85% loan to cost on our construction financing. So for those of you who are maybe unfamiliar with construction financing, most lenders will only go to 65% in order to protect the risk level of the projects. And so on this side, the lender basically came back and said, you know what? We think this is a really easy play. We know that these can qualify under CMHC based off of the experience, and we're very familiar with the process. So we're going to take most of the risk on, and we're going to let your investors come in at a significantly reduced equity requirement. So in essence, on our build, we're basically looking at an investor that only needs to come in at $440,000 to get a brand new 5 unit built in Toronto. So if you're going to compare that to say another investment option in Toronto, you're probably going to end up looking at, a dumpier triplex or fourplex for those of you that unfamiliar, you're probably looking around $2 million. So on a standard residential down payment, you're looking at around 400,000 is what you're going to be using anyway in Toronto to get something like that. So in this regard, you're actually ending up with a brand new build with significantly better numbers in returns or cash flow on that side. As I was saying on the next point, so you receive immediate cash flow. One of the requirements on the CMHC program, MLI Select, is that the project has to have a coverage on a debt service coverage ratio of 1 to 1 after all expenses and income, so that the project is cash flowing. So you're running at about $1,000 to $1,800 cash flow positive each month after all the expenses. The way that we also designed this kind of setup or structure was, so normally from a builder perspective, I would go out, I would basically pay my investors interest. I would then go out and select the lot, go and build it, bring it to market, and then I'd receive the appreciation for that property or the profit side. So what we've actually done is, instead of taking that, we're actually offering that to the investor. So we've built in a project management cost. So at the end of the day, the investor actually receives all of the appreciation in the project. The project becomes 100% of theirs, so they control the whole project from start to finish. Um, it's also a turnkey, so we do handle all the CMHC leasing up, which is required prior to CMHC doing their takeout. The lender is offering basically a turnkey financing solution, so which is extremely rare to find, where they have partnered with an A lender who will do the land acquisition with the investor. They'll then take them into the construction right from there, and then into CMHC at the end. So you don't need to go to a number of different lenders or pay lenders fees. you can go directly to the lender and they will underwrite, and then they will take you through the entire process from start to finish. So you're kind of getting the benefits, as I've got here, of 15 years of development and build experience with our team. And then on top of that, you're getting a lender who's handling basically turnkey financing from start to finish and handling that CMHC takeout for you. The other real big benefit as well, or a couple benefits, is because of this structure, the investor gets to select the lot that they want to work with. So instead of me going out and acquiring that lot and then building it and saying to a buyer, you're going to take it if you want it here. And if not, then you're going to have to wait for the next one. And hopefully it's in that area you're going to take. In this scenario or situation, you actually end up getting to select the lot in Toronto. So we would go out with you and work. So if you decide that you want to invest in, say, Etobicoke, then we would work with you to find a lot in Etobicoke that would work. The other benefit here too, because we've taken out that equity component and we're giving it to you, it allows for a refinance at between 95 and 100% loan to cost. So at 95% of the loan to cost numbers, of that 440,000 that you've initially invested, you're actually getting back 300 of that. So you're only in equity side about $144,000. If we actually meet the budget and we hit the timelines, then you're actually out of the project 100% and you're still receiving the cash flow and the equity at the end of the day for it. So I'll give you kind of a couple of components here. I'll show you the design of the build that we're going to be, or that we offer. So as I was saying, it's standardized. So each investor basically gets slotted on kind of a build schedule. So each investor gets the same build. It's just obviously a different site each time that we're working with, but the builds are all the same. And that's basically to keep our numbers and our timelines on track. And it also is a build that we've done for numerous years. So each time we've done a new iteration of it or a new version, we've actually looked at it and talked to the tenants for feedback so that we can refine the layouts. So that we have what we find as the optimal layout that's going to give us the rents that we're looking for. So kind of some of the benefits here, as you can see, so they're fairly large for Toronto at 958 square feet to 980. They're obviously in good areas. We select areas near transit. So currently we're working on a couple down on Lawrence and Jane, if you're familiar with that. So right near the Weston GO station. They all come with terraces or outdoor space. There's parking and storage included, and each unit is separately self-contained. So all units have their own private entrances and they all have their own separate HVAC systems. So we've pushed on as much of the costing onto the tenants from the actual investor. So the only thing the investor is paying is for their taxes for the property, their water bill, and then basically for landscaping and snow removal. All the other utility costs and that have been pushed on to the tenants. The other kind of benefit with the building too is it's set up so that there are some areas in Toronto that are zoned for 6 units. So the build can be converted very easily into 6 units to take advantage of the extra income. And as well, it is structured and set up so that down the road, if somebody decided that they wanted to turn it into condos, they could do that. So very easy to split that off, sever them, and then sell them off individually. This right here kind of gives you the financials. So I won't go into a significant amount of detail on this, just so that obviously because of our time. But this kind of gives you the numbers. So the valuation that we're looking at here for the property would be approximately 3.2 million. So that's based off of a cap rate that we're running at currently what our projects are selling for now. So we're running about a 4 or 5 on the cap side. You'll notice on the project economics, so the land value you're going to be paying is around 950,000. You've got your construction costs, soft costs. We've also built in 2 guardrails. So there's a financing reserve fund of 242,000. So that's about double what we anticipate for the financing costs. And there's also 130,000 built into the construction costs. So we've tried to design this so that we don't have to go back to the investor for any additional funds throughout the project. I also will mention timeline wise. So our build is designed for modular. So we do have the exterior and the framing all produced in factory, and the project timeline to actually have that installed is 4 days. So once we've got our foundation in, the build actually goes up in 4.5 days, and then we're into our exterior and then into our rough ends. So timeline for construction, we're looking about 8 to 9 months. Permitting, we're about three and a half. So the build should the full timeline is approximately 1 year to have this done. Um, on the loan side, as you can see here, once we go to sources and uses, you're going to notice, so the lender is giving you $2.4 million for the full project, so just shy of 85%. So your borrower's equity, the amount that you're going to have to come up with would be the 434,600. Then if we go over here, so on the second slide on the financial model, so you're going to notice here that we've got so on the left side, you're going to see the CMHC baseline numbers. So these are all numbers that are basically provided by CMHC other than the rental numbers. So for the revenue for what we're getting on the rents, these are current actuals on what our units are renting for currently. The expense side is basically what CMHC uses. So for the program, they will basically, for new construction, they have certain numbers that they just use per unit, and that's all built into a calculator that then spits out what the total loan amount is that they're going to provide you with. So as you can see here, that we're estimating that, as you can see here, cap rate at about 4.3 is that 3.2. So if you then move over to the right side, you're going to see the takeout summary. So your total net income, operating income here is 138,000. The net loan amount that you should receive on the side here, so let me get this here, is going to be 270 or 2.725 million from CMHC. Your rate is going to be, at this time, it was at 3.5. It's now reduced to about 3.2, I think is what we're kind of running, which could push your loan amount up a little bit more. We're working on a 40-year amortization is what this build offers. And then you're going to notice that on your equity remaining at the bottom here, you're basically into it for 141,000, which is your 5%. Cash on cash yield, you can see at the bottom here is 8.58. And then as I was saying, so the reason that we can get to 100% on the loan to cost is, as I was mentioning, we've got two buffers. So we've got the 130,000 of construction overage cost and then the interest reserve surplus. So if those come back, or even a portion of those come back, then you're looking at basically 100% refinance. So that'll cover your $141,000. So finally, we've just kind of done a quick market comparison or investment comparison to a couple different options. So just as I was kind of speaking, so if you're looking at a standard investment property, there's one that was listed downtown Toronto as older triplex. Price was at 1.6. So you're looking at a 20% down payment because it's a standard residential mortgage, 20%. So your gross rent there on that property was 8,700, less your cost of the mortgage, which only offered a 40-year and it was at 4%. So you're only making about 2,400, and that's pretty much eaten or ate up by your taxes and your expenses. So you're in a negative cash flow position. Market wise, if you're taking 435 and you're doing a 12% return over 18 months, you're going to come out with 78,000. For 141,000 over 12 months at a 12% return, you're at 17,000. So if you compare it over to an MLI Select option on this model, you're basically your investment at 435,000. So using that equity or that estimated or appraised value at 3.2, you're coming out with 365,400 of equity that's yours. And then you're getting back that 300,000 of your initial investment. And then if you're at the 5% loan to cost scenario and you're working at 141,000 in there, then your estimated cash flow over the 12 months is 19,370. So that's kind of the model that we're working with. Personally, I've never seen a lender before willing to go up to an 85% on the construction side. I think this is a really good opportunity for an investor to come in and like I said, Toronto's a stable market. We're always going to have significant amounts of renters and individuals coming into the city, and this basically gets you into a brand new investment property in Toronto that's cash flowing, and you're either buying it for 100, in essence, 141,000, or you're basically getting it for free at the end of the day on the amount of cash that's coming out.
Thanks for watching. We just heard from Kevin talking about the missing middle in Toronto. Obviously, this is a concept that applies to all markets across real estate investing in general. Um, Let us know what you thought. Drop a comment. Did you like it? Does it apply to you? Is it something you're interested in learning more about? Let us know. Hit that like button, subscribe, turn on the bell for notifications. That way you can be informed when our new videos drop. And we look forward to seeing you on the call. Come join us every Wednesday night, 7:30 Eastern Time. Link is in the comments.